This is a Zambian Breweries financial statement analysis by Derek Munyinya for Dr. Brian Gaulu of the University of Zambia. Now, this analysis that we want to do is strictly for academic purposes. So, I'm going to be analyzing the financial statements of Zambian Breweries from 2021, 2022, and 2023 using financial statements ratios. Now, before we get into the analysis itself, just want to give you an overview of what Zambian Breweries is. So this Zambian Breweries is a Zambian company that is specialized in production of liquor. It is a leading liquor company in the country Zambia as we speak now. So to begin with, I'm going to start with our profitability ratios. So these, they just show us how profitable has the company been from 2021 up to 2023. Now let's begin with the net profit margin. Let's look at the net profit margins of this company from 2021. So in 2021, what we are saying here is that the net profit margin, it is slightly below 5%, which is 4.8%. In 2022, it is at 2.7%, so it has reduced. In 2023, it has gone into negatives. It is at 12.9%, which is net loss. So just from the net profit margins, what we are seeing is that from 2021 up to 2023, actually Zambian Breweries hasn't been making profit. They've been running into loss, which is not a very good indicator. Let's check from the gross profit margins perspective and see what we're going to get from there. Now, in terms of gross profit margin, in 2021, it is at 34%. 2022, it is at 37.2%, and in 2023, it is at 25%. It's giving some kind of a fluctuating figures, but what we are saying is that from 34, slight increase to 37, and a drastic reduced to 25%. Also, it's not giving a very good sign. Now, let's go to also, we check the operating profit margin. So, the operating profit margin in 2021, it is at 6.2%. In 2022, it is at 8%, and in 2023, it is at 10.6%. Now, overall, what do we have to say on the profitability ratios of Zambian Breweries from 2021 up to 2023? It is that the profitability ratios are showing that Zambian Breweries hasn't been making good profit. They are showing that Zambian Breweries has been running in losses in this financial period. Let's check from the liquidity point of view. So let's analyze this from the liquidity ratios. Now, what do liquidity ratios do? Liquidity ratios, they measure a company's ability to meet its short-term obligations. Let's begin with the current ratio. The current ratio is just the ability of the company to pay off its short-term obligations using all of its current assets. Now, what we are seeing is that, let's begin, as I said, with the current ratio, right? What we are saying is that in 2021, the current ratio is at if we put it in percent, it is at somewhere 55%, or it is at 0.5% in 2021. 2021. Then in 2022, it is at the same range, which is 0.6. In 2023, it is at 0.2. So now, this current ratio, what it means here when we say in 2021 it is at 0.6, what we are saying is that for every one kwacha that Zambrew owes, they only have 0.5 ngwe to pay, or 0.6 ngwe to pay, remaining with a deficit of 0.4. So they are not able to meet, they were not able to meet their short-term obligations. Maybe in 2022, let's check. Same. In 2023, it has actually drastically reduced. So what we are seeing is that by virtue of current ratios, the company is not able to meet its short-term obligations. Now let's check on quick ratio. So quick ratio, we are just saying the company's ability to meet its short-term obligations using its most liquid, assets, but minus its most liquid assets, just minus inventory. Now, in 2021, when you check there the quick ratio, in 2021, as we are seeing on the graph, it is at 0.2. In 2022, it is at 0.3. In 2021, it is at 0.1. So, again, Zambrew is not able to meet its short-term obligations using its most liquid assets. Let's check the cash ratio. This one, the company's ability to meet its short-term obligations using the cash that it has and everything that is cash equivalent. In 2021, it is at 0.7. In 2022, it is at 0.1. In 2023, it is at 0.6. Again, the same signal is showing that by virtue of the liquidity ratios, this is now a conclusion on the liquidity ratios. By virtue of the liquidity ratios, the company is not able to meet its short-term obligations, so which is not a very good signal. And this actually is correlating with the profitability ratios that we are showing that the company is not profitable. Now, let's also look at this from the efficiency ratios point of view. Let's also check the efficiency ratios. Now, the efficiency ratios, they just measure how a company uses its assets and liabilities to generate sales and maximize profit. And we begin with the inventory turnover. We begin with the inventory turnover. So the inventory turnover period. Now, the inventory turnover period is just how often inventory is sold and replaced. How often inventory is sold and replaced. So how often does the company sell inventory? Like how often do they make revenue or sell and be able to order again? So in 2021, what we are seeing is that in 109 days at least, so it is in 109 days at least they are able to finish off their inventory and buy again. So it is in that number of days. In 2022, it is at 145. In 2023, it is at 86. So what we are seeing is that their inventory turnover period, it is reducing from 2021 to 2023, which is a very good sign for the company. Which is a very good sign for the company. What we are seeing is that as it is reducing, it is showing that the turnover, at least it is increasing. So let's check the receivable turnover. So the time it takes for them to collect cash or to collect their monies from their the, to collect their monies from their customers. In 2021, there it is showing that in 28 days they're able to do that. In 2022, 35 days. In 2023, 5 days, which is also very good. They're able to collect their monies. Max, I think, as you are seeing from the ratios here, max, it takes them a month. Just within a month, they should be able to collect their monies from their customers. Then also let's look at the payable turnover period. So let's also look at the payable turnover period. From 2021, it takes them 219 days. 2022, 280 days. 2023, it takes them 361 days, which is a year, and this is not a very good sign for the company. Now let's look at solvency ratio of this, how much of the financing of this company comes from debt and the like. So this is what we will be looking at. Let's begin with the debt to equity ratio. In 2021, it is at 2.1. Now what this means is that in 2021, much of the equity or much of the financing for Zambian breweries is coming from debt. In 2022, it is at 2.9, and in 2023 it is at 7.5. So this is not a very good sign for the company, because it is showing that much of the equity, much of the financing of this company, it is coming from debt. Now, against what we saw there, that the company is not profitable, yet on the other hand, it is highly borrowing. It is highly borrowing, so which is not a very good sign for the company. First that I'm going to move on to is to give advice to one who is considering to invest at least the sum of 1.5 billion into Zambian breweries. The advice that I could give based on what the ratios are showing here is that don't invest now in Zambian breweries because it is not profitable. Wait until Zambian Breweries becomes profitable, so you could look at the years to come, just so that we just observe how profitable Zambian Breweries would become. But currently, the advice is that you don't invest now, because based on the financial ratios, Zambian Breweries, it is not profitable. It would be investing into an entity that is not profitable at a time. So thank you. This has been Derek Munyinya presenting on financial analysis for Zambian Breweries.